The committee will come to order, and without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Oversight of the SEC's Division of Corporation Finance, and we're very pleased to have Mr. Bill Hinman here. I do want to take a personal point of privilege, though, here a moment, and I know it is Take Your Child to Work Day. We have one special guest, one Mr. Donald, young Master Donald, over here. Donald McGann is joining us, and he's going to be headed over to the White House. So if you have a judicial appointment, this isn't the right Don McGann you want to get to. The other one's he'll be with the other one in a little later. So. I know for my own children over the years, it's always been a great opportunity, so we're glad that we could have this day. So I'm going to recognize myself now for 3 minutes to give a quick opening statement. As we all know, the Securities and Exchange Commission has a three-part mission: protect investors, maintain fair, orderly, and efficient markets, and to facilitate capital formation. Today's hearing will focus on the policies and procedures of the SEC's Division of Corporation Finance. CorpFin, as the office is better known, is responsible for ensuring that investors are provided with materially complete and accurate information in order to make informed voting and investment decisions. This includes disclosure requirements when the company initially offers its securities to the public and on a continuing and periodic basis. CorpFin also provides interpretive guidance to companies regarding SEC rules and forms and makes recommendations to the Commission on new rules and revisions to existing rules. The Division of CorpFin's activities and responsibilities include regularly monitoring and reviewing filings made under the Securities Act of 1933 and Securities Exchange Act of 1934 to ensure compliance with disclosure and accounting requirements, conducting a comprehensive review of the SEC's rules governing public company disclosure, completing rulemakings to implement disclosure-related provisions of the Dodd-Frank Act, and to conduct oversight of the proxy process, including the activities of proxy advisory firms. One of my biggest concerns is the declining number of public companies, which has led to fewer investment opportunities for Main Street investors. IPOs have historically been one of the most meaningful steps in the life cycle of a company. Going public not only affords companies many benefits, including access to the public capital markets, but IPOs are important to the investing public as well. Already, the recently enacted Tax Cuts and Jobs Act has strengthened our economy at the local, regional, and national level. By making our tax code more competitive, we have signaled to the world that America is again open for business, investment, and job creation. To build on this success, we must continue with the pro-growth reforms that ensure the United States has the strongest, deepest, and most liquid markets in the world. Unfortunately, from a regulatory standpoint, it has become increasingly apparent that our capital markets are becoming less and less attractive to growing businesses due to the quote-unquote one-size-fits-all securities regulations currently in place. Let's work together to reverse this negative trend of declining IPOs and focus on capital formation. Hardworking families in West Michigan and across the nation rely on capital markets to save for everything from college to retirement. By making capital formation the priority, we can maximize Mr. and Mrs. 401k's return on their investment, expand opportunity, and increase job creation and grow our economy. The chair now recognizes the ranking member of gentlelady from New York, Ms. Maloney, for 5 minutes for an opening statement.
Thank you. Thank you so much, and thank you for holding this important hearing, Mr. Chairman. The SEC's Division of Corporation Finance is arguably the most important division in the SEC because it is responsible for ensuring that investors have access to all the information they need to make informed investment decisions. They review the financial statements and disclosures that companies file and ensure that they are both complete and accurate. This is critically important because investors simply will not invest in a company unless they have confidence in the company's financial statements, understands the business model, and is aware of all the risks that the company faces. The fact that investors all around the world are so eager to invest in the public companies is a testament to the confidence investors have in the disclosure framework that Congress and the SEC have developed over the years. In my personal view, we shouldn't make significant changes to that disclosure framework lightly, And when in doubt, we should err more on the side of more disclosure, not less. But the Division of Corporate Finance has another role too. It also reviews the filings that companies make for their IPOs when they are offering securities to the public for the very first time. In these reviews, the SEC staff reviews the company's IPO filings to ensure that the company is complying with the federal securities law. One very important provision that public companies have to comply with is the so-called, quote, anti-waiver provision, which prohibits companies from waiving compliance with the federal securities law. For example, a company can't require all its investors to agree not to sue them for securities fraud, or to allow the company to file their financial statements only once every 2 years rather than every quarter. The anti-waiver provision ensures that the basic investor protections in the securities law, including the right to sue companies for securities fraud, are guaranteed for all investors. So I was troubled when I read an article in Bloomberg in January that said the SEC staff was laying the groundwork for a change that would allow public companies to strip investors of their right to sue for securities fraud in court and instead force all of those claims into secret arbitration proceedings. Last month, I led a letter to SEC Chairman Clayton, which was signed by every single Democrat on the Financial Services Committee. The Senate has also sent over a letter strongly opposing any effort to allow public companies to insert these forced arbitration clauses into their corporation governance documents. And I ask unanimous consent to place in the record my letter, Mr. Chairman.
Without objection.
Let's be clear about the stakes here. If the SEC allows companies to use these forced arbitration clauses, that would essentially be the end of any securities fraud cases in public courts. And it would definitely be the end of class action lawsuits for securities fraud. So when the next Enron or WorldCom comes around, shareholders who've been defrauded wouldn't be able to hold these companies accountable in court at all. The reason this issue is so important for this hearing is simple. If a company that is preparing for an IPO tries to insert a forced arbitration clause into its corporate governance documents, it would be the staff in the Division of Corporation Finance who would have to decide whether that forced arbitration clause violates federal securities laws. For decades, the SEC's position has been that forced arbitration clauses violate the anti-waiver provision of the Exchange Act. So allowing companies to use these clauses would be an enormous change in policy that would affect every single investor in our markets. So I'll be very interested to hear Mr. Hinman's thoughts on this, and will expect to hear whether he supports any efforts to reverse the SEC's long-standing position on the use of forced arbitration clauses in the bylaws of public companies. I thank you, Mr. Chairman, and I yield my remaining seconds to my dear friend and colleague. I just had to get that into the record because I feel it's important, but he deserves a lot more time than what I'm yielding him.
Bitcoin is a security in that it is an investment. Investment protection is your business, and obviously initial coin offerings. And the tax bill that the chairman refers to says you can have a 0% tax on the profit of your factory, but only if you move that factory to a foreign country. I yield back.
Gentlelady's time has expired. We do need a copy of the letter. We have not seen the letter. All right, that will be inserted in. So with that, Mr. Hinman, we welcome you here and appreciate your time and the attention. And I'm sorry I was being delinquent. I have 2 minutes remaining in which I am going to be recognizing the Vice Chair of the Capital Markets Committee, Mr. Hultgren from Illinois, for 2 minutes.
Thanks, Chairman Huizinga. Thank you for convening this hearing today. I've been very pleased with the new leadership that we've seen at the SEC under Chairman Clayton, but I do value these opportunities to have the a chance to discuss the Commission's work to promote capital formation and investor protection. My constituents have been extremely happy with the strong economic growth we've seen over the last year. I believe much of the growth is attributable to tax reform, but the common sense regulatory relief and reform across governments has also been extremely important. I'm especially pleased that Chairman Clayton has acknowledged the importance of reducing burdens on public companies in order to increase opportunities for all investors. One of the challenges I hear about most frequently from public companies or companies interested in going public is challenges with the shareholder proposal process. This committee has spent a significant amount of time exploring the damaging effects of activist investors using the shareholder proposal process to achieve social change, but this is at the detriment of investors who are simply seeking to build wealth. These are many of my constituents who are seeking to save for retirement. According to Proxy Monitor in 2017, proposals related to social or policy concerns that did not relate to long-term shareholder value represented over half of the proposals. This committee has advanced a number of legislative proposals to address such issues, including a number of provisions of the Financial Choice Act. I'm interested in hearing about how the Commission can use its existing authority to revisit the shareholder resubmission thresholds under Rule 14A8. Last March, under the leadership of Acting Chairman Pure, the Commission proposed a new rule to adopt inline XBRL to merge traditional unstructured filings submitted by public companies and mutual funds with the standardized machine-readable XBRL formats into a single filing. At the time, Ranking Member Maloney and I wrote the Commission to encourage them to pursue this work to modernize these filings. I believe this is important to both investors and market surveillance by the Commission. I hope we'll be able to discuss this and that maybe you can give us an update on this work. Thank you again, Chairman, for holding this hearing, and I yield back the balance of my time.
Gentleman's time has expired. With that, today we welcome the testimony of Mr. William Bill Hinman, Director of the SEC's Division of Corporation Finance. Mr. Hinman, you'll be recognized for 5 minutes to give an oral presentation of your testimony, and without objection, your written statement will be added into the record. So with that, Mr. Hinman, you are recognized.
Well, thank you very much, Chairman Huizenga, Ranking Member Maloney, and members of the subcommittee. Thank you for inviting me to testify on behalf of the SEC's Division of Corporation Finance. Since arriving at the SEC in May of 2017, I have felt very privileged to work alongside the division's dedicated and talented staff. As you mentioned, Chairman, the mission of the SEC is to protect investors, maintain fair and orderly, efficient markets, and facilitate capital formation. Our division oversees the review of the disclosures of companies, and we seek to ensure that investors have access to the important information they need to make informed voting and investment decisions. In addition, the division provides interpretive advice about securities laws, makes recommendations to the Commission for rulemaking in areas of disclosure and securities offerings, and the division stands ready to collaborate with companies in discussing how to comply with federal securities laws. Our reviews of reporting companies monitor and enhance compliance of the disclosure and accounting requirements we impose. The Sarbanes-Oxley Act requires us to review the financial statements of reporting companies at least once every 3 years. In addition to these mandated reviews, the division selectively reviews filings made for other offerings, business combinations, transactions, and proxy solicitations. Due to the declining number of U.S. public reporting companies, the division has been considering ways to make the public company alternative more attractive. To the extent we're able to attract more companies to join our reporting system and to do so at an earlier stage, it will ultimately benefit those companies, our markets, and investors. Companies that go through the evolution from a private company to a public company emerge as stronger companies and with better disclosure. Investors also benefit when there are more public companies in which to invest. This is a high priority, and we are taking policy and rulemaking steps in this effort. For example, in July of 2017, the division expanded its non-public review process for draft registration statements. This expanded policy now applies to all IPOs for all issuers, not just emerging growth companies, and it allows follow-on offerings during that first year of being a public company to be submitted on a draft basis. Companies are taking advantage of that process. It saves them money. It allows them to better access market windows. Under this expanded process, we received draft submissions from more than 20 IPOs and more than 50 follow-on offerings from registrants that would not have qualified for that review process under the old rules. We're hearing that this is very helpful. Through this process, companies can avoid preparing and filing interim financial information for draft filings if that information will be superseded by the time it's made public. We still perform complete filing reviews. Investors still continue to receive the full financial information and other required disclosure at the time they publicly file. We've also been working to assist companies in their efforts to comply with our rules in other areas. Over the past months, the Commission and the Division has issued interpretations of the pay ratio disclosure requirements, the new tax reform law, and cybersecurity disclosures. The Division has also been focusing attention on digital assets and on initial coin offerings. As this area continues to evolve, we are striving for a balanced approach, and one that encourages capital formation while maintaining a strong focus on investor protection. We also are keenly focused on the importance of capital formation by small and emerging companies. Congress and the Commission have taken steps in recent years to provide additional capital raising avenues through Regulation A, securities-based crowdfunding, and Regulation D. While at the same time we're doing this, we're maintaining robust investor protections under those new exemptions. We continue to monitor the use of these exemptions, and we engage with a wide range of interested parties at meetings and at conferences around the United States to see how they're being used. We recognize that small companies and their investors could also benefit from reduced regulatory complexity. We're considering ways to harmonize and streamline our exempt offering rules. Further, the Division continues to work on reforms to make our disclosure regime more effective. The staff is working to finalize a recommendation for the Commission to raise the financial thresholds below which companies will qualify for scale disclosures as smaller reporting companies. We're reviewing our disclosure requirements and regulations SK and SX and considering other ways to improve the disclosure regime for both investors and companies. In addition to our disclosure reform efforts, we're working to fulfill other rulemaking responsibilities, including disclosure rules relating to resource extraction, conflict minerals, and executive compensation. The Division is also exploring where there are rules that could encourage more companies to go through the IPO process, and we are thinking about extending the Test the Waters provisions that was enacted in the Jobs Act for emerging growth companies to a wider range of participants. Thank you very much for inviting me to discuss the Division's activities and responsibilities. I look forward to answering your questions.
Thank you. And with that, I will recognize myself for 5 minutes for questioning. So, and as you have talked about in this, and I can't stress enough my concern about the number of IPOs that are happening or frankly not happening. We have about half as many public companies in the U.S. as we did 20 years ago. I think that is detrimental to investors, the common investors, not institutional investors. And I'm very pleased to hear you say that the Division is looking at ways to make the IPO market more vibrant. And can you elaborate a little more on the Division's capital formation agenda and discuss your priorities for enacting and encouraging more companies to go and stay public?
Sure. Thank you for that question. We're doing a number of things. Some things require rulemaking, and that's a longer process, which is one of the reasons we first did this broadening of the confidential review process. We have heard that companies find it much more useful to be able to time the public announcement of their offering closer to the time they actually expect to go to market. That gives the company less exposure to market vagaries. That also works in their first year as a public company, where prior to being S3 eligible, companies would have to file and wait perhaps as much as a month before they could go to market. Now with a confidential review process, that window is much shorter and they have much less exposure to market fluctuations during that period. And that is helping people achieve more liquidity sooner, which is good for investors. That's one area. We have been trying to streamline our guidance and make it more transparent to users. We have done things as simple as putting more of our direct phone numbers in our manuals that the public sees so that they can reach people more quickly on issues.
Actual live people, not voicemail trees.
It still may go to voicemail, but it goes at least to the right voicemail box, and sometimes people pick up their line. But we've now identified the people and the phone numbers in the areas you might be interested in and made that quite public. There's an area we've had authority for a long time under Rule 313 of SX to provide waivers of financial statement requirements when those statements would not serve investors but may be very burdensome to prepare. We've reduced the amount of time it takes a company to go through that process. And we've encouraged companies to come to us earlier in the process and not wait and develop an expensive 30-page letter why we should receive a waiver, but to talk to us earlier and find out where our head is on that and see if we can accommodate the request or not, but to save money in the process. And of course, on the rulemaking side, we are doing a number of things which I can elaborate on if time permits.
Great. Well, in 2011, there was an IPO task force that asked public company CEOs, 92% of them said that the, quote, administrative burden of public reporting was a significant challenge to completing an IPO, and so I appreciate that, that cumulative effect of those being looked at. My colleague brought up ICOs. I want to touch on those as well. Do you believe that ICOs could be a potential solution to the declining number of IPOs? I want to have you touch on that. Kind of what, you can hit on this if you'd like, the differences between an ICO and an IPO, but do you believe that there are any circumstances, instances where an initial coin offering should not be regulated as an offering of securities? And some have discussed the concept of a utility token. So if you can maybe take the next minute and a half and touch base.
Sure. I think the chairman has made a number of statements around the use of this new technology, and we very much want to see our efforts not stifle innovation in that area. And so we have developed working groups that cross the divisions, my division, trading and markets, investment management, to work with issuers who are interested in complying with our securities offering rules as they explore these new technologies. The issues around whether a particular coin offering may involve an offering of a security are somewhat complex, but the drafters of the 33 Act were quite wise and added very flexible provisions there. And so an instrument that may be called a coin may still have the hallmarks of a security and need to be regulated as such, and be done on a registered basis or on an exempt basis. And we work with issuers that are exploring those options.
Can you come up with an instance when they wouldn't or shouldn't be viewed as securities?
In theory, there is a time when a coin may achieve sort of a decentralized utility in the marketplace. There are some coins where you wouldn't have an issuer to regulate. They operate on their own. Our rules, which look to protect investors by providing disclosure, generally require some centralized authority to make those disclosures. In theory, there may be coins where that lack of central actor would make it difficult to regulate at least the offerings as a securities offering. Okay. That said, if someone's raising money and they have a stake in that, and they're promoting that, that's usually the central authority we're looking to for disclosure. Okay.
My time has expired. With that, I recognize the gentlelady from New York for 5 minutes.
Thank you. Mr. Hinman, as I mentioned in my opening statement, I led a letter to Chairman Clayton that every single Democrat signed and strongly opposing any effort to allow public companies to use forced arbitration clauses as on their own shareholders. And if the SEC allowed this, it would essentially be the end of securities fraud cases in federal court, and it would deprive shareholders of their ability to hold companies accountable for fraud. I think we can all agree that this would be an absurd and wrong result. And as you know, Chairman Clayton sent us a response on Tuesday which included an analysis by your division at the SEC. And while I appreciate Chairman Clayton's and your detailed response and how seriously both of you looked at our letter, I do have a question for you. If it was reported earlier, it was actually reported earlier this year by Bloomberg that the SEC staff was, quote, laying the groundwork to start allowing these forced arbitration provisions. And so I want to ask you, are you or any of the staff in the department of the division at the SEC actively encouraging companies to submit registration statements that with forced arbitration provisions in them?
So I think the letter that you referenced in response to your inquiry and the other committee members' inquiry covers that point. This is something the chairman and we are not actively looking at in terms of trying to bring something in and address this issue. It's a complex issue. It involves our laws and regulations. It involves other federal laws, such as the Federal Arbitration Act, and state laws. And as the chairman's correspondence noted, if this issue were to come forward to my division in the context you mentioned of IPO of a U.S. company, we would not be declaring that registration statement effective at the division level. We recognize that this is an important issue that's in the correspondence, and that's something that we would defer to the entire commission.
And then where did this report in Bloomberg come from that the SEC was actively pursuing this course?
I hate to speculate where the press gets some ideas. I do know that it correlated to a conference that was held in California. The SEC was not in attendance because the government was in shutdown. And so I think panel members there were speculating, and I think it got translated into the article you read.
Okay, thank you. Last year, this committee marked up the Republicans' Choice Act, which made sweeping changes to the securities law. One provision of the act that got a lot of attention would have raised the threshold for shareholders who are allowed to put proposals on a public company's ballot. And currently, a shareholder can submit a proposal as long as he or she has held either $2,000 or 1% of the company's stock for at least 1 year. The Choice Act would have eliminated the $2,000 threshold and would also have lengthened the holding period from 1 year to 3, which means that in order to submit a proposal, shareholders would need to own at least 1% of the company's stock for 3 years. This would make it virtually impossible for ordinary shareholders to submit proposals at the largest companies. For example, under the Choice Act, for a shareholder to submit a proposal at Wells Fargo, he or she would have to own $2.7 billion worth of Wells Fargo stock and hold it for 3 years. So my question is, do you believe that only shareholders who own more than 1% of very large companies like Wells Fargo should be able to submit shareholder proposals to get voted on at annual meetings? Or do you believe that would unfairly restrict the ability of small shareholders to participate and try to influence the companies that they own?
Right. So in the shareholder proposal area in general, we don't have a rule proposal moving forward at this time. The proposal thresholds that you mentioned, 2%, or excuse me, $2,000 are the current rules that we're operating under. Those are somewhat aged. They haven't been looked at in, I think, over 20 years in terms of either adjusting those for inflation or otherwise. There have, from time to time, been discussions around what would the right threshold be. If we were to engage in rulemaking there, we would receive comments from a wide range of people and consider all of them. We do see the value of the shareholder proposal process and giving shareholders access to the proxy to express their opinions. So we would be mindful of that as we develop whatever new or updated rule in this area we would come up with.
Thank you. My time's expired. Thank you.
The lady's time has expired. Gentleman from Illinois, Mr. Holgren, for 5 minutes.
Thank you, Chairman. Thank you, Director. Appreciate you being here. As a proponent of seeing all aspects of our government innovate with technology, I've been closely following the way the Division of Corporate Finance has been trying to implement the use of machine-readable, searchable, structured data formats in its operations. To that end, what efficiencies and productivity gains has the division been able to realize in analyzing filings as it has continued to innovate with standardized data?
So the XBRL tagging of information does assist us as we try to review companies. We now have more modern tools to use some of those items to screen for certain characteristics of a financial statement. So we have found them to be of value.
Great. Yeah, on March 1st of last year, 2017, Commissioners Pior and Stein proposed a new rule to adopt inline XBRL to merge the traditional unstructured filings with the standardized machine-readable XBRL formats into a single filing. I authored a letter to the Commission with Ranking Member Maloney and Representative Issa, with whom have championed the Financial Transparency Act to encourage the Commission to continue this work. I wonder if you could give us an update on where this proposed inline XBRL reform stands.
It's something we're actively working on. I do expect to get something out in the next 12 months in that area.
Great, thank you. Chairman Clayton has indicated that on the Commission's longer-term agenda is reviewing shareholder engagement in the proxy process. This is something that we've touched on a little bit already, but want to go in a little bit different direction. As you know, the House has passed legislation sponsored by Chairman Duffy that brings long overdue transparency, supervision, and accountability to proxy advisory firms. In November, Chairman Clayton stated that the Commission should be, and I quote, lifting the hood and taking a hard look at whether the needs of shareholders and companies are being met, end quote. I've heard from a number of companies and shareholders that feel their current needs are certainly not being met. There is particular concern regarding proxy advisory firms and the outsized influence they seem to have in the market, yet they're subject to little oversight and are susceptible to conflicts of interest. I was particularly concerned when I was advised of a filing earlier this month from one pharmaceutical company, Abbott Labs, that a proxy advisory firm they engaged with was, and I quote, aware of the flaws and inaccuracies of its report and has disregarded our attempts to correct them and proceeded to publish a flawed and inaccurate report, end quote. Wonder, do you have any updates for the committee regarding when the Commission will be addressing issues like this? Will the Commission reopen the comment file of the 2010 proxy plumbing concept release?
Well, as you mentioned, this is an area of interest for the chairman. He and I meet periodically with investor groups, the funds, and the advisory firms themselves to talk this through. We are still sort of gathering information. The chairman has indicated in some of his speeches informally that proxy plumbing is a topic of interest. We're developing some ideas in terms of what comments to ask for in that area. This is certainly on the list of things that we're considering. In the meantime, we are applying our 2014 guidance, which does apply more rigor to the process and watching for compliance in that area.
Great, thanks. As you know, SEC's Rule 14A8 provides an opportunity for a shareholder owning a relatively small amount of the company's securities to have his or her proposal placed alongside management's proposals in that company's proxy material for presentation to a vote at an annual or special meeting of shareholders. The rule generally requires the company to include the proposal unless the shareholder has not complied with the rule's procedural requirements or the proposal falls within one of the rule's 13 substantive bases for exclusion. On September 22nd, 2016, the Capital Markets Subcommittee held a hearing entitled Corporate Governance, Fostering a System that Promotes Capital Formation and Maximizes Shareholder Value, where witnesses from the Society of Corporate Secretaries and the Business Roundtable provided compelling testimony for making updates in order to reduce unnecessary regulatory burdens. The Financial Choice Act, that's been discussed, proposed a number of changes to Rule 14A8 that I think would be valuable for public companies, investors, and our markets. I wonder, does the Commission plan to revisit Rule 14A8, and specifically, what are your views on increasing the resubmission thresholds under 14A8?
Well, to the extent we would reopen 14A8, which I mentioned, that would probably happen in the context of this request for more comment on a wide range of proxy issues. In terms of the thresholds, we would look at where they are. They, like the initial submission threshold, the resubmission thresholds for once a proposal has been voted down, can it be submitted again? Those two have not been looked at for some time, so we would be very interested in public comment on those provisions. In the meantime, one of the things that we are doing is trying to get more input from the company's boards on these topics. So we put out a staff legal bulletin this past year asking for the board's more in-depth analysis. That has created more engagement between boards and shareholders. Some of these proposals go away after that engagement happens, but it allows us to make rulings on whether it's something that can be excluded or not more effectively.
Thanks, Director. And my time has expired.
Gentleman's time has expired. The gentleman from California is recognized for 5 minutes.
I'd like to talk about parity between disclosing long positions versus short positions. As you know, securities law requires investors or certain investors to disclose their long positions 45 days after the end of each quarter, to require institutions to make disclosures within 10 days after their position reaches 5% of a company's outstanding shares. But there's nothing corresponding for those taking short positions. Now, I'm not criticizing short positions. However, there is an asymmetry of information. It's my understanding that several European countries require the disclosure of short positions. Here in the United States, the principles that underlie Section 13 disclosure requirements applicable to investors with long positions, transparency, fairness, and efficiency, apply equally to investors with significant short positions. Moreover, investors with short positions can pursue strategies designed to invisibly drive down share prices or rely on regulatory processes to challenge the intellectual property of a company intending to profit from the uncertainty created. To provide transparency to other investors in affected companies, would you support extending the existing disclosure requirements for long investors, such as those on Forms 13F, Schedule 13D, and Schedule 13G, to persons with short positions, including any agreements or understandings that allow an investor to profit from a loss in the value of a security?
Well, thanks for the question. There has been some experimentation in the disclosures around short positions post-financial crisis. Certain institutions were required to disclose in real time their short positions. And DERA, our economic analysis division, had an opportunity to look at the cost benefits there.
I know you've looked at it.
Yes.
Where do you stand?
In that provision, I think they concluded that there was not a good return cost benefit for real-time reporting of all transactions.
Well, the long positions aren't, for the most part, real time. Why not throw away the disclosure of long position? I mean, why require one without a cost-benefit analysis and then say to the other, oh, we've decided it isn't worth doing?
Again, I think this is something that DERA would need to look at before we did it, because it would have market effects. And I haven't done that work myself.
Let me shift to another issue. Chairman says that the decline in IPOs might be replaced by an increase in ICOs, initial coin offerings. And I think we missed the mark in this meeting, because we think that the reason for security markets is to let people issue and trade and be securities lawyers and be government bureau executives, et cetera. The reason for security markets is to provide jobs in the real economy. And an IPO does that. An ICO does the opposite. It takes money out of the real economy. It takes people willing to invest and risk and says, don't use that ability to risk, don't use those animal spirits to help create a job for a person who needs one, let alone build a factory for thousands. Sit there and trade back and forth in the ICO. Now, these are investments. They are, I think it was you that said a balanced approach. The balance we have in the real economy is, on the one hand, we want people to invest in new companies and factories and provide jobs, but on the other hand, we want to protect investors, so we have a lot of burdens on somebody who wants to build a new factory. But with the coins, there is no factory, there is no jobs, and we have no burden on the no investor protection. When you strike a balance between those who are trying to create a new currency to facilitate drugs, tax evasion, to deprive the Fed of its ability to market our securities and return $100 billion or so to the U.S. Treasury, all the balances are for total investor protection, which could be achieved by totally banning. Why aren't you stopping all the ICOs, which are clearly unregulated investments?
So when I talked about taking a balanced approach, what we are trying to do is recognize this new technology, specifically the blockchain technology that underlies it, may have some promise.
Oh, I'm not saying ban blockchain, just ban the ICOs.
Okay. Some folks are finding that the ICO instrument allows for a different type of enterprise, one that's more decentralized, and which they think has some value. We are
charlatans and scammers have always favored decentralized new enterprises. I yield back.
Gentleman's time has expired. With that, the chair recognizes the gentlelady from Missouri, Ms. Wagner, for 5 minutes.
Thank you, Chairman Huizinga. Director Hinman, as you noted in your written testimony, your role is to support the SEC's mission to protect investors as well as to maintain fair, orderly, and efficient markets. To follow up on my colleague, Representative Holmgren's questioning, there are some red flags when it comes to in particular to the two largest proxy advisor firms, who together seem to control at least 97% of the proxy advisory industry. Director Hinman, what are the main factors hindering greater competition in the proxy advisory industry, do you think?
I'm not an economist, so it's hard for me to know exactly what would hinder more competition there. I do know that the service they provide is basically collecting all of the proxies that are out there, looking through and thinking about how should a particular matter be voted on. Once someone does all that work and there's one or two people supplying that, it's hard for a new entrant to come in.
What steps is the division taking to ensure that all proxy advisory firm conflicts of interest are properly disclosed?
Well, that was something that we emphasized strongly in our legal bulletin that came out in mid-2014. And we, through our Office of Inspections, continue to look at how that's being complied with. And we are seeing better disclosure than what predated that guidance.
What steps is the division taking to ensure that public companies have sufficient time to respond to errors or flaws that are made in proxy advisory firm recommendations?
As I mentioned earlier, we do meet with these firms. We have provided feedback around the kinds of concerns you are raising, and we have seen an increase in the level of some responsiveness. We're still monitoring it, but we do think encouraging the firms that are providing these services to listen more actively is something that we can do and are doing.
Switching topics, I wanted to spend some time talking about cybersecurity attacks. On February 21st, 2018, the SEC voted unanimously to approve updated interpretive guidance to assist public companies in preparing disclosures about cybersecurity risks and incidents. How does this guidance expand upon the guidance issued in 2011?
Sure. One of the basic differences is where it was issued. The original guidance was issued in my division. This was done by the full commission and therefore has more weight. But in terms of the substance, there were maybe 3 or 4 areas that we concentrated on and brought attention to. One was disclosure controls. We reminded companies it's very important for them to take cyber risk into account when they're looking at their disclosure controls, so that if an attack happens and someone on the front line sees that, they raise it through the company's disclosure experts, and more consideration is given to timely disclosure. We also reminded companies that as that happens, to enforce their insider trading policies. So now that they have a better sense of what's going on at a higher level, they're more apt to apply their insider trading policies.
Well, given the increasing number of cybersecurity breaches, such as the Equifax breach, how does this guidance help to ensure that companies have the appropriate procedures in place to both prevent and respond to cyber security incidents?
Well, what we were trying to do was to emphasize this disclosure point. We also, the third one of the other items that's a little different than the old guidance was that we said when a company has cyber risk as a material risk that they face, we expect to see disclosures of how their board is overseeing that risk. So board oversight, better controls, and more compliance on the insider trading policies are the.
To that point, can you walk me through some more of the steps you believe a company should take after they have discovered material cybersecurity event has occurred?
Sure. After it's been discovered and you've determined it's material, and that may take a little time because these companies are attacked daily, and so one of the reasons we wanted this to be elevated was to make that materiality decision that you're referencing. Once that decision has been made, insiders with knowledge of that should not trade, and the company, we would expect, would be moving to formulating appropriate disclosures.
So about the disclosure forms, you do believe that the company should be using the disclosure material information related to cybersecurity?
I want to make sure I understand.
What disclosure forms do you think they should be using in the event that that they have an event dealing with related to the cybersecurity breach?
There are a number of ways. The most common we see is Form 8K. Where, that is something that's not done just quarterly or annually, but can be done at the time an event is occurring.
My time has expired, Mr. Chairman.
Gentlelady's time has expired. The gentleman from Massachusetts is recognized for 5 minutes.
Thank you, Mr. Chairman. If we could, I'd like to stay right on the same topic that the gentlelady from Missouri was talking about. So last year we had an increase of about 80% in the number of cyber attacks. As the gentlelady pointed out, we haven't updated this guidance on cybersecurity protocols since 2011. So exponentially increased in the number of attacks. But last year, if you sort out the cyber attacks, the significant cyber attacks on publicly traded companies, about 82 of those companies that are publicly traded that had major cyber attacks on their systems, only 3% filed an 8K to inform the shareholders that their systems had been hacked. So you got 97% of the companies that have been hacked failed to file an 8K to let their shareholders know that there had been a significant event. And the problem seems to be on the definition of materiality. The legal counsel within the company is nervous about disclosing the hack because share price will drop and there's vulnerability, and so that's an issue. But on the other hand, the shareholders have a right to know, and also if we don't do anything about that, I think this trend will continue. The companies will not improve there's no price to pay, there's no accountability. The companies will not improve their cyber protections, and we'll just keep seeing the volume of these hacks continue. How do we get at that decision-making being made at the corporate level to encourage? You don't want to punish a company that's a victim of a cyber attack. I understand that, but you do want to encourage them to disclose. I mean, that's basically the mission of the SEC. How do we get these companies to come forward so that we'll know about the attacks in a timely fashion and protect the shareholders and also the entire system, because everything is so interconnected?
Well, thank you for the question. We agree that this is an important disclosure issue and that the materiality judgment can be a difficult one, but we do expect more. And so, as you mentioned, the 2011 guidance has actually been updated at the beginning of this year by the full commission, and it highlights some of the items I've mentioned. Beyond that, we do our reviews of companies. This is an item of review priority for us. We look at those each year, and this is clearly one that we are looking at. And then, moreover, when we see a hack occur, we will often pick up the phone. Our review teams that are familiar with that particular company may pick up the phone, talk to counsel, and ask to be walked through, is this something that's material? You'll see things sometimes reported in the press, and the company has decided it's not material. We sometimes will ask to walk us through that analysis.
Yeah, it's still fairly discretionary, however, and timing is important. What we're seeing right now is, like I said before, 97% not filing an 8K, not telling people. There needs to be some consequences. I was hopeful that the new guidance would get at that issue. I'm not sure if a legislative solution is the best way to go here. I'd rather have it from the rulemaking, have the SEC do it themselves, but it's not happening fast enough, in my opinion. But I appreciate your willingness to come here before the committee and help us with our work, and I yield back the balance of my time. Thank you.
Gentleman yields back. With that, gentleman from Minnesota is recognized for 5 minutes.
Thank you, Mr. Chair. Director Hinman, welcome to the committee, and congratulations on your new position. You touched on it briefly during your testimony. However, can you give more detail as to why it's so important for the SEC to encourage more small companies to go public, not just the big ones?
Well, we think capital formation at all levels and the small levels are important for job formation, number one, which we think is obviously good for the economy. And we are very interested in looking at our rules. Over the years, there's been more and more added to the disclosure requirements, and we do want to look at the scaling of those requirements for smaller companies. We do have a rule actively being considered right now. It's been proposed, and we will try to finalize it for lifting the limits for who qualifies for that scale of reporting.
Well, when Chairman Clayton came before this committee in the fall, I asked him about the concept of venture exchanges and whether or not the creation of a lower-tier equity market to facilitate the secondary trading of shares of smaller companies or liquidity-challenged securities would entice more early-stage IPOs. Do you have any thoughts on this matter?
Sure. I'm not the trading and markets expert, and our colleagues in the Trading and Markets Division actually are focused on the issue. In fact, they had a roundtable earlier this week, I believe, to discuss some of the issues smaller companies face in terms of developing liquidity in their shares and smaller company trading. Venture exchanges, ideas like that, where liquidity is enhanced and an exchange is used to do that, certainly would provide more liquidity. And I think, again, the trading and markets folks are very interested in exploring those ideas, why they're holding these roundtables.
Wonderful. I want to change gears just a little bit. I find people tend to fear what they don't know. And if people who started sailing the oceans at the time of Columbus would have believed that the world was flat, we never would have had the great discoveries of the New World. The typical attitude, too, that I get from so many elected officials who have no idea what they're talking about, they're ignorant on a topic, is that everyone who is involved in the area that they maintain their greatest ignorance, that everyone who is participating in that area is either bad or dishonest. And therefore, the elected official must rush in and help people from these. I find this a lot when we talk about initial coin offerings. We're talking about blockchain technology. There's a lot of ignorance about how special this area is. And given your division's jurisdiction as it relates to cryptocurrencies and initial coin offerings, do you have any circumstances that come to mind that might render a token sale as something other than a securities offering?
The initial sale, it's quite hard to have an initial sale without having a securities offering, which is why the chairman has noted that the initial sale of these may require compliance or exemptions.
Well, let me ask you a question about that. Is it possible that a utility token would not be a security because it's not done for capital formation?
It is certainly possible that there are tokens that would not have the hallmarks of a security. And over time, many of these fundraisings are intended to develop networks where a token may be used to buy a good or service, and that's its only use. It doesn't have much utility.
No, I understand, but there's a difference.
In other senses.
If you can just, this is the difference. I mean, I get this all the time. People are suggesting that everything that is done in this area involves a currency or something like a currency or a security. But in fact, a security or a utility token is nothing more than a card, if you would, that will allow you access to a certain platform so that you can participate. Is it possible in your jurisdiction that that may not qualify as something that's a security offering?
We certainly can imagine a token where the holder is buying it for its utility and not as an investment. And in those cases, especially if it's a decentralized network in which it's used and they're not central actors, we would have just information asymmetries where they know more than the investors in those tokens.
I got to get this in before my time runs out. You've stated that, quote, sponsors of offerings conducted through the use of a distributed ledger or blockchain technology must comply with the securities law, close quote. You also stated, quote, investors need the essential facts behind any investment opportunity so they can make fully informed decisions. How can we improve the regulatory clarity for entrepreneurs here in the United States so that their contribution to something that may not be a security will not see enforcement actions by the SEC?
I'll allow a quick reply. One of the things we're doing is meeting with the participants who have these ideas that think that they may have a token that shouldn't be regulated as a security, to work through with them how that may be structured.
Wonderful. I'll follow up in writing. I've got a bunch of other questions. Thank you for your patience, Mr. Chair.
Gentleman's time has expired. With that, gentleman from Georgia, Mr. Scott's recognized for 5 minutes.
Thank you, Chairman Hangsack. I'm very, very pleased to have Mr. Hyman here because you are in the crucible of what we really refer to as wealth building in this country. You are the SEC Director of the Division of Corporation Finance and Capital Formation and Public Offerings. There are basically three ways we build wealth, meaning financial security and stability, and that is either through a job, your business, but most acutely through investments. And so I want to talk to you about the fact that we have some alarming news. My excellent staff has done some research that I want to bring to your attention. Important research. One, they've informed me that during the past 20 years, the number of new companies deciding not to go public has increased dramatically. As a matter of fact, they informed me that in 1997, we had 474 companies went public, while only 108 went public in 2017. That is astounding. So with this in mind, I wanted to ask you about this expanded use of non-registered offering exemptions, because I truly believe that it makes sense to expand our security laws to make it easier for our businesses, especially our startups that we rely on. Small businesses, startups are still the driving force. And from that comes the necessary resources to make those investments through the public and private offering. So, and one other thing I want to tell you is that I agree with you when you said this in your testimony. You said this, you said it is far more efficient for retail investors to invest in companies through our public markets rather than our private markets. That to me is very profound. As a matter of fact, I think it gives us the nobility of purpose why you're here. So, and you went further. You said this. You said the SEC is conducting a look-back review of the impact regulation, crowdfunding, and Regulation A on capital formation and investment protection. So, my question is this. I'm very interested to know, first of all, what you think about the points I've made, and also how this look back is going with you. I'm curious to know if the SEC is including its look back, in its look back, a measure of whether our capital markets are operating efficiently from the standpoint of retail investors.
Well, thanks for the question, and to comment on your observations around the decline in numbers of public companies or companies deciding to do IPOs. We share that concern. We do think, as you mentioned, I said in my testimony, that public companies are terrific vehicles for the smaller investor to invest in. There's more liquidity, and because of our regulations, there's more transparency. So we do share a concern if those numbers are declining in terms of the number of investment options retail investors in particular may have. In terms of the various ways that our rules are working together to hopefully encourage people to join the public reporting system, you've mentioned crowdfunding and Regulation A. I think Regulation A, at the time it was expanded by Congress, the thought was this was perhaps a bit of a roadmap to becoming public, and It's still very early days in terms of experience of Regulation A. We have seen some Regulation A issuers get used to the idea of providing disclosure and having it reviewed by the SEC, and then maturing to the point where they now have a few that have been listed. Not all those are great successes. In the same way, not all IPOs are great successes. And so we are monitoring the developments under Regulation A carefully. Same with crowdfunding. With crowdfunding, we see a lot of activity on the coasts. We see less in the middle of the country. We think it would be terrific to have more activity there. We're looking at ways to stimulate portals' interest in folks across the country, not just on the coast.
Thank you very much, Mr. Chairman. Mr. Hammond.
Gentleman's time has expired. Gentleman from New Jersey, Mr. MacArthur, is recognized for 5 minutes.
Well, thank you, Chairman. Director, thank you for being here. Forgive me if I work on fields that have already been plowed, but I had to step out for a few minutes, so I don't know what you've been talking about. In the chairman's opening remarks, he mentioned that primary goals are protecting investors, facilitating orderly markets, encouraging capital formation. One of the concerns I have is we have a lot fewer initial public offerings than we used to. And so we have to consider, why is there less interest in the market, in the public markets? And one of the things I've observed is that companies engaged in interstate commerce that are traded on public exchanges have a very difficult situation in both state and federal actions that target them for civil fraud, not criminal fraud, but civil fraud. So, for example, an overzealous state attorney general might not be able to, might not have a case that rises to the burden of proof to prove civil fraud. They'll accuse a company anyway, and that company can get raked over the coals for something that doesn't even have any intent. This is not unique to one state alone. It's not even unique just to the states. For example, CFPB raked a company in my district over the coals and ended up losing their actions, but the company lost $1 billion in market value, which hurt all of their Main Street investors. States like New York, California, Connecticut have gone after companies and decimated shareholder value. That hurts Main Street investors, and it's hard for those companies to recover. The moment there's an accusation of anything, they have to disclose it because they're publicly traded companies. So I just wanted to ask you if you could comment on the problem, how you see it, the fact that these publicly traded companies engaged in interstate commerce all across the country are subjected to 50 different standards on civil fraud. Could you talk about the problem from your perspective, and do you see any solutions? I'd be happy to hear those too.
Sure. So to go to the broader point, the fewer public companies, what are the reasons? Is this one of them? I think there are a number of reasons why fewer companies are choosing to go public. There's the federal regulatory burden. There's the state regulatory burdens. There's simply more money available in the private sector right now as well. So the need to seek public funding is lower than it would have been in the past. So there's all these different factors going on all at the same time. So to pick one out and to sort of try to weigh it in the equation, it's difficult. The point you're raising is something that it's not something I have a view on as a federal regulator. The ability to change that landscape would be one of federal statute. I mean, that's a federal preemption question, really, that you're getting to if you were trying to make a more uniform anti-fraud landscape for public companies.
Do you see it as a problem? As
certainly,
part of the issue?
I certainly see that some companies bear that in mind as they decide to go public, and it's not a positive factor.
And I agree with you that it's not the only issue. I didn't mean to imply that it was, but I know as a former businessman, it certainly weighed into my mind just the difficulty of the environment. And you mentioned there's more capital available in other mechanisms like private equity and such, but there's a reason more capital is being attracted into that space too. It's because the public markets are less attractive. Mr. Chairman, I'm happy to yield my remaining time to you if you have any other comments or questions.
Thank you. Yeah, I will take that we're going to go in a slightly different direction from sort of what you were having. And I want to touch base on something that Chair Clayton and CFTC Chairman Giancarlo stated, that they, along with their counterparts at the Department of Treasury and the Federal Reserve, may come to Congress in the coming months regarding ICOs. And I'm curious what you believe that the role for Congress might be in that, and is there concern that the congressional or regulatory intervention will chill the ICO market? And is that okay?
Okay. In terms of what's going on in the landscape right now, I think Treasury through the FSOC committee is trying to gather views from the various regulators, the FTC and us principally, but some of the banking regulators, everyone that participates in FSOC, people that have know your customer concerns, anti-money laundering concerns, our securities law concerns, commodities concerns, to look at the overall regulatory touch here, to see if there are gaps and to see if there's ways to improve the environment. One thing we're trying to do is provide as much guidance as we can to the marketplace so we don't have a chilling effect. But it's still something that's being worked on by all the agencies, and we're trying to coordinate to make sure we don't foul innovation.
Thank you. Time has expired. With that, gentleman from North Carolina, Mr. Budd, is recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you, Director Hinman, for your service. For the first time out, you're doing a good job. So
thank you.
Thank you. I want to talk this morning about SEC efforts to facilitate capital formation and efforts to increase investment opportunities here at home. Obviously, this is an issue of importance to me, and I've led H.R. 3903, the Encouraging Public Offerings Act, along with my friend, Representative Meeks from New York, and that would expand testing the waters. So a lot of us on committee were pleased to see the SEC expand the use of submitting confidential draft filings last year just from emerging growth companies to all companies. In that vein, do you plan on extending the use of testing the waters from these emerging growth companies to all companies as well? And what steps are the division taking to help facilitate pre-IPO communications between businesses and investors?
Well, thanks for that. As you point out, the Test the Waters exemptions from Section 5 have been available for the emerging growth companies, and we have put on our agenda expanding that. It seems to be working well. There are parameters in which those Test the Waters activities take place. We think investors are protected by those, and we have, as I said in my opening remarks, that this is something that we think could make a difference, and we'll explore it very carefully.
So just to clarify, you said it's on your agenda. Is there any timeline for expanding that?
I don't think we have it on a specific timeline right now, but it is something that we would like to move forward, and I don't think it will take an inordinate amount of time to sort of duplicate what we've done for the EGCs for a broader group of folks.
Very good. So in a speech earlier this year, you stated that your intent is to put emerging growth companies and non-EGCs on as level a playing field as possible. Can you please elaborate on this and how the division aims to ensure that this is a level playing field?
Well, one of the primary things would be looking at the EGC opportunity to test the waters and broadening that. There had been, prior to the revisions we made in the policies, certain advantages the EGCs had in terms of confidential filings, which we've spoken about. That's been extended to all. And then as we expanded confidential filings beyond what the EGCs had available, we made sure that both the EGC group and others were allowed to file confidentially for their first year. So we kept them on the same level playing field.
Very good. Appreciate your time. And Chairman, I yield back.
Gentleman from North Carolina yields back. The gentleman from New York, Mr. Meeks, is recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you. Let me ask you a question, Mr. Hyman. Over the years, we've seen an increase in the amount of public companies with dual-class share structures, including many of the largest tech companies in Silicon Valley like Google, Facebook, Snap, LinkedIn. These structures can create benefits for a company by allowing founders to guide a company's success after going public. But such structures also pose risk for shareholders who are less able to hold boards and CEOs accountable for their failures. The SEC's Investor Advisory Committee recently proposed ways of improving disclosures related to dual-class shares. So, my question to you is, what's your personal opinion of those recommendations and the risk associated with dual-class share structures?
Thanks for the question. You're right, the advisory committee did ask us to look at those disclosures. I had independently talked with our disclosure teams about the disclosures that we are able to receive when a company has a dual class or a unique structure. And we are looking for robust disclosure there so investors understand not just the voting ratios, but things like the life of the arrangement, whether it has a sunset. Those provisions we are looking for disclosure. The advisory committee did not ask us to ban those, in part because the SEC really doesn't have jurisdiction on this topic to ban or allow. We are, as you know, a disclosure agency. State law generally governs whether a dual class is allowed or not, or how it may be limited. So we look to the state law to see whether these are allowed. But if they're allowed, we're then focused on disclosure. Our jurisdiction in this area has been limited by case law and by the statutory scheme.
So you don't believe that the SEC has any plans for considering and or adopting the recommendations?
Again, what we can do is focus on the disclosure. Because it's case law that has limited our ability to legislate one share, one vote. That was done many years ago in a business roundtable case, which the SEC did not prevail on. We see our focus now as one of disclosure.
Let me jump to another issue in my last 2 minutes. Earlier this year, New York's comptroller announced that the state's pension fund would oppose re-election of all directors of boards that lack women representation. New York was unable to make a similar action with respect to boards that lack racial or ethnic diversity because the SEC's board diversity rule has not yielded robust disclosures. And this has been a constant problem and complaint of my office and investors that we've talked to nationwide. In October, when Chairman Clayton was here, we asked whether or not the agency would adopt a proposal from the SEC's Advisory Committee on Small and Emerging Companies that requires companies to specifically list the race, gender, and ethnicity of their board members. Chairman Clayton made no commitments to adopt these recommendations and merely stated that the Division of Corporation Finance, your division, will monitor compliance with the current rule. So, what has been your division's assessment of compliance with the agency's board diversity rule? Has diversity disclosures been adequate considering shareholder demands for more information? And will the Division for Corporation Finance eventually provide a public recommendation to the SEC on whether it should adopt proposals to improve the rule?
To start with your last question, the answer would be yes, we will. It is on the chairman's rulemaking agenda. This is a topic that both he and I view as highly important. The old policy in this space has been subject to some criticism that it doesn't give enough useful disclosure. Our division has been looking at how that policy has been complied with. Some companies, notwithstanding the fact that the disclosure doesn't require specific items such as gender or race or ethnicity to be disclosed, have been providing that disclosure. Sometimes in graphic form, tables. We've been looking at how are people approaching the issue. We've talked to some of those issuers to find out what's their experience been in doing those kinds of disclosures. One thing that we have discovered is that there is some sensitivity to their board members' privacy issues in terms of self-identifying on some of these topics. So we didn't want to take that into account as we develop any new rules here. But it is something that we are gathering information. It's on the rulemaking agenda. And again, it's important to both myself and the chairman.
Thank you very much.
Gentleman's time has expired. With that, the gentleman from Maine, Mr. Poliquin, is recognized for 5 minutes.
Thank you, Mr. Chairman, very much. Thank you very much, Mr. Hinman, for being here. I represent rural Maine. We have a huge congressional district geographically with lots of hardworking folks and small savers with 401ks and IRAs and 529 plans for their kids to go to school and to plan for their own retirement. So I'm very concerned about small savers and small investors in Maine and throughout America, Mr. Hinman. Now, there's a bill that that I originated called, well, it's 1312, HR 1312, which deals with the annual forum, that business forum, government business forum, that you folks host every year, and you get together and you get all these great ideas from folks and on the public side, in the private side, to see if there are ways that we can improve the enhancement of capital formation in our economy. And the bill, sir, which is included in Mr. Crapo's bill over in the Senate, simply requires the SEC to make sure they take a look at every recommendation, evaluate them, and act upon them. Are you familiar with that bill, sir?
I have heard it, yes.
Okay. And do you right now go through the process of making sure the recommendations from that annual business forum are evaluated by the SEC?
Certainly. I personally participated in that forum.
Thank you.
And in Texas this year, and we see the report. My staff in the small business office receives that, helps compile it, helps get it out, and we take all the recommendations under consideration. We're always looking for good ideas.
That's great. Since you have personal knowledge of this, Mr. Hinman, I appreciate that very much. We just want to make sure that folks that go through the effort like you in your former life do not let these recommendations, which could help our economy grow and thrive and companies raise more capital, just don't sit on the shelf somewhere, but they're actually evaluated and looked at and make sure that that information is useful to everybody. Okay, I'd like to move on a little bit to data security here, sir. On Tuesday, the former Yahoo company paid about $35 million in a penalty because you folks determined they misled investors when it comes to a hacking that took place that disclosed the personal data of hundreds of millions of accounts around the world. Are you comfortable that the SEC has the metrics in place such that public companies know, in fact, when they should disclose material events like this?
We do think we have given very good guidance in this space. We don't use bright line metrics, in part because those bright lines sometimes will result in over-inclusive disclosures or under-inclusive. You know, if someone's on one side, still might be material to an investor, but they would say, oh, we didn't have to disclose because we didn't meet the metric, and we don't want to flood the market with things that are, you know, just noise. So the bright line tests don't seem to work that well in this space, and we have used basically principle-based guidance and have elaborated on that in a 30-page commission-level guidance document most recently.
I just want to make sure that you folks are giving every due consideration for investors, small investors who have taken a position in a company, and at the same time making sure that you don't overly burden companies with this. So it seems like you're moving down that path. On a third issue, quickly, sir, if I may, is that there seems to be over the years the threshold for small groups of political activists to take $2,000 positions in companies in order to push a specific agenda at a shareholder annual meeting is something that's a concern to companies that are thinking about going public. And I wonder if you have any input on that. I know the number of companies that have gone public over the years have dropped precipitously. And also I noticed that Mr. Clayton, in his speech last November, said he had a concern about this threshold. And do you have any feelings at the SEC where those thresholds may or may not be adjusted to make sure folks do have a voice if they own part of a public company, but at the same time it's not so disruptive and costly for the company that they hurt small investors who've actually bought shares in the company also?
We're certainly looking at the right balance there. You pointed out the issues in terms of you want to make sure that shareholders still are able to have a voice, and you don't want to overburden the company with trivia. And so those thresholds haven't been looked at in quite some time. I mentioned earlier today that we do have an interest in looking at that. The chairman is going to be seeking more comment in the space. He has, as you mentioned in his speech, expressed interest here, and I expect that will continue.
Great, thank you. And with indulgence, Mr. Chairman, please, the state of Maine, Mr. Hinman, as a 2.6 unemployment rate. I think it's the lowest in the country, and clearly lower taxes for our families and small businesses is having a dramatic effect. And I know you folks are responsible for making sure public companies disclose this good news of more growth and more hiring and for their companies. Are you comfortable with the right balance between making sure they report this great news to their shareholders, but at the same time not overburdening them with more costly regulations that would be hurtful?
We're very focused on that.
Thank you, sir. Thank you, Mr. Chairman.
Gentleman's time has expired. Gentleman from Minnesota, Mr. Ellison's recognized for 5 minutes.
Thank you, sir. Director Hinman, when do you expect to finalize the executive compensation rule, Section 953A, which requires companies to detail the relationship between CEO pay and profits?
So that rule is on the chairman's agenda. We don't have a date certain. There isn't, as you know, in the statute, unlike some of the other Dodd-Frank provisions, a mandated date. He has indicated he wants to go through all of the executive compensation rules of Dodd-Frank in order, and that is one we will get to, but he hasn't set a date for us yet.
When do you expect to finalize the clawback rules so that CEOs who jack up their incentive pay to increase profits only to have those profits tank have their incentive pay clawed back?
That's part of that package, so it would be the same approach.
Any date on that? You can give us a range, like next year, like next month, any sort of like a, I understand you may not know the exact date, but just if you can give us some sense, because the public would like to know, my constituents want to know.
Right. I would say it would not be in this fiscal year. The short-term agenda is pretty packed. We're trying to achieve everything that's on there. And so I would think it would be sometime after this fiscal year.
And when do you think you'll finalize the incentive-based compensation guidelines for large financial institutions?
That would be this, again, that's part of that package of 3 compensation-related initiatives, and so it fits into that same category. And I think the chairman wants to look at those together and take them in order.
Okay, do you think they'll come all out together at the same time, or you don't know?
I think he will likely ask us to do these in sequential order.
Okay.
But that's up to the chairman. I haven't heard what the order would be or whether there would be a possibility of soliciting comment collectively.
All right. Just want to give you a little context for my question. You know, one of the lessons that I think we learned from the Great Recession, just 10 years ago, which I still remember very well, is that CEO pay incentives were actually encouraging CEOs to engage in activity that I think put a premium on risk-taking. If we had a better incentive structure, more risk assessment, greater oversight at the corporate level, we may not have engaged in some of the things that really hit our economy hard. So when pay is tied to short-term profits, CEOs will take risks that prioritize quick returns. And so when Congress wrote Dodd-Frank, Congress included a number of provisions to ensure CEO pay was no longer promoting excessive risk-taking. The SEC is charged with promulgating the rules here, and it's been 8 years since Dodd-Frank, and we still don't have the final rules. And so I'm not blaming you personally, but I think that there's been plenty enough time, and I'm disappointed to hear that, you know, we're not going to be having those rules in this fiscal year. And I think that there's been more than ample time. And by the way, the delay has been costly. We've seen some serious banking crises that could have been avoided in part with better CEO pay regulations. You know, look at Wells Fargo, for example. They were trying to pump up profits every quarter by creating fake accounts. I know a lot of workers got fired, but the people who directed and designed the program, I think the CEO got away with a $173 million severance package or something like that. Anyway, New York State Controller Thomas DiNapoli sent a letter to Wells Fargo shareholders last week in advance of their annual meeting asking for Wells to disclose their pay incentive policies. And I'll tell you what he said in that letter. He said, incentive pay practices have been identified as contributing to the multiple crises at Wells Fargo. Investors need to know whether the company has taken steps to identify employees incentive-based compensation that could spur conduct that puts the bank, its customers, and investors at risk, I will say the economy, if widespread enough. And so, look, I don't believe in beating up on witnesses unless they kind of got it coming. I don't think you do. But I will say, I hope you take back to the people you work with that 8 years is plenty enough. And this is a serious thing. It's the law, and it's got to get handled quickly. So I don't think the American people can afford to wait much longer. And I think until these rules are finalized, CEOs are still getting pay packages that misalign their shareholders with their own compensation. And I don't think that's right. So, thank you.
Gentleman's time has expired. The gentleman from Indiana, Mr. Hollingsworth, is recognized for 5 minutes.
Well, good morning. I really appreciate you being here, and I will be brief and want to focus on a very narrow topic that's really important to me, important to Hoosiers back home, and frankly, I think important to America as a whole. And that really has to do with some of our emerging growth companies, and specifically those involved in biotech. The Economist kind of tongue-in-cheek remark that all that is required for one to get a drug approved in this country is superhuman persistence over 10 years and $2 billion, right? And so many of these companies are very early stage. Many of these companies are very small in terms of the number of employees, even if their market cap is relatively large, and just waiting on approval of drugs, waiting on approvals to be able to get through the process. And one of the things I continue to hear from them is concern about 404B compliance and the cost of 404B compliance. We've heard testimony in this very room about companies that are on the cutting edge of new technology, cutting edge of new biology, and being able to finally cure diseases that ail millions of Americans, but are spending more and more of those dollars that they've raised on compliance instead of the search for cures. I know in a 2011 SEC study noted that those companies with a public float between $75 million and $250 million spend on average $840,000 a year on compliance with 404. And really what I wanted to ask you was if there's any look at the cost of 404B on very, very small companies that are public and the benefits of 404B for those very small companies that are public, and whether we can better align those two to ensure that we're enabling and empowering them to do more of what they do best, serve their customers, research technology, develop new products, instead of more and more compliance.
Right. Well, thank you for the question. We are looking at that very carefully. As I think you probably know, today we draw the line at $75 million of market cap. Right. Below that, 404B attestation is not required. We're doing some things, scaling disclosures up to the $250 million capital market cap. That's something where the SEC, in a proposed rule, decided we would not move the 404B. We suggested we would not move the 404B threshold along with the rest of those requirements. We are taking a fresh look at that. The life science industry, as you mentioned, makes a fair point that this is costly for them, and they have lots of terrific ways to spend money. At the same time, we want to protect investors, and so we want to have perhaps a more sophisticated test in this area. So we wouldn't look just at market cap. We also might look at revenues. And if you are a low revenue company but a higher market cap, you probably have some promising product in the pipeline. You don't have the revenues, but people value you highly. You probably also have a simpler set of financial statements. Where the requirements to do a full attestation, maybe that's not money well spent. We haven't analyzed that yet in terms of having DERA look at, is there a better way to draw the lines here? That's something we're quite interested in doing. Your life science industry colleagues have suggested that we do that, and I think that's a good idea.
Well, Mr. Hinman, you've stolen all of my thunder because that's exactly where I was going, in the hope that we would have a more sophisticated test, right? Some of these biotech companies have $1 billion in float, but they have 7 employees and are outsourcing their drug trial process, right? This is expensive to go through, and we heard some testimony from individuals that were kind of in that same camp, right? We earn $10 million a year from licensing a few things, but we've got $1 billion float while we wait to go through this process, and we certainly don't believe that we should be held to the same levels as a larger, more operating entity with many more employees, many more moving parts, many more subsidiaries, et cetera. So I really appreciate the fact that you've brought that up and want to look at a more sophisticated and thorough test to better understand what companies can benefit that. Just one last point, since you stole most of my thunder in the middle here, is nothing that you would do I imagine, would say you are absolutely barred and restricted from getting any 404B to any of these companies. If they elected to say, look, it lowers our equity cost of capital if we underwent a 404B audit attestation, they could still pursue that if they wanted to at any level.
You're absolutely right, and some companies do that.
Right, and the reality is they can make that as a business decision, right? As you well said and have said on many occasions, disclosure can benefit companies as well in ensuring that investors feel more comfortable with the asset that they own and lowering their equity cost of capital. And I don't think anything that I've proposed, anything that this committee's voted on, anything that I've heard from other testimony says we should bar companies from doing this at any size, but instead, let's make it up to those companies to determine whether it's in their best interest, their investors' best interest, their product's best interest to do this, or whether it's not at a certain level or not. So thank you for being here. Thank you for your testimony today.
Thank you.
Gentleman yields back. With that, the chair recognizes gentleman from Ohio, Mr. Davidson, for 5 minutes.
Thank you, Chairman. And Mr. Hinman, Director Hinman, thank you for your testimony today. And I want to return to the topic of initial coin offerings. And I want to focus particularly on the Howey test. As you know, the Howey test is used to determine whether an asset is classified as a security and therefore subject to federal securities laws. The test was developed by the 1946 Supreme Court case, SEC versus W.J. Howey Company. Do you believe the Howey test is adequate for application for cryptocurrencies?
I think the principles enunciated there are still solid principles in terms of the factors one would weigh to see if an investment contract could be viewed as a security.
Do you believe that it should be updated or changed to better incorporate what is in fact a security?
Again, I do think the basic principles there, is the investor giving money or some consideration to a third party to have an enterprise take that money and generate a return? That feels to me like those are pretty flexible and sound hallmarks of how to judge whether an instrument is a security.
Well, as you were speaking with Chairman Huizenga earlier, a little concerned by kind of the idea that the SEC would inherently be involved in an ICO, though you left some latitude to say that perhaps it wouldn't meet. And so when you look at the criteria, there's an investment of money, there's an expectation of profits, the investment of money is in a common enterprise, and any profits come from the efforts of a promoter or third party. Some of those offerings of coins, as disclosed currently in white papers, are really almost like prepaid cards. They're not really securities. In some cases, they're assets for sure, but is it a security? Is it a commodity? And as some migrate, is it really even a currency? And so I'm encouraged by the work of FSOC to try to bridge that understanding, and our office is working to help provide clarity as to where those lines should be drawn, because there isn't clarity in law, or it's certainly been tested. And one of the ways it's been tested is with SAFs, which is, let me get the correct piece of this acronym. Are you familiar with this acronym?
I am. Simple Agreement for a Future Token.
Right, there you go, future. So this is because there's no guarantee that there's future profits to the holder of the token. The token would simply be able to be traded at some point. Currently, the investment wouldn't necessarily have a lot of value, but at some point it may, and then therefore the token, even in the early stages, would be able to be exchanged. What's your assessment of the path on SAFT?
Well, a number of folks who have tried to raise funds through the SAFT technique have an interesting idea. They say that they will eventually have a network on which this token may be used, and if that network is developed, the token may have more value than it does day one. People who are buying those into those agreements are hoping that that happens, that those developers and other parties are actually able to do that. So you have all the hallmarks there. You have, I'm giving money to the person who's giving me the SAFT. I hope that they will develop this network and that it will have more value and give me a return. So at early days, before that network exists, and before that token has real utility, it probably is a security. In theory, there may be a time when the developers go away, and what you have is a token that can be used. To use your Howie analogy, in the Howie case, you had a developer putting together this orange grove, tending to it, making it work, and selling interest in it. And people viewed this, the court viewed that as an investment contract because this developer knew how this was going to progress. He had more information about it than the people he was selling the contract to. Someday, in theory, he could have gone away, and people could have come in and tended to the groves themselves, or parties that participate in these decentralized networks, their equivalent could have tended to the grove, and those oranges probably wouldn't be securities. So, you know, I think that analogy somewhat works to say, correct, at some point, you may have a token that doesn't represent an investment in the efforts of others, in this case, the Howie Hill Service.
Thank you. As my time winds down, I would just say there's a clear distinction there between jurisdiction in the SEC, the Commodities Future Trading Commission. I'm glad FSOC's paying attention to it, as is our office, and as you can tell, as is our committee. So I look forward to future collaboration. My time has expired, and I yield.
Gentlemen's time has expired. Seeing no other members on the other side, we will go to Mr. Hill of Arkansas for 5 minutes.
Thank the Chairman. Appreciate you testifying today. Glad to have you before the panel, and also delighted you bring your years of private sector experience and transactions to the division. That's an important skill set, so appreciate your public service. In my non-public service, a lot of that time was spent raising money for startup businesses and growth enterprises, and frequently that we use the Reg D exemption for raising those dollars. And so a couple of things. On the issue of the definition of accredited investor, I see in your testimony the division is considering recommending to the Commission proposed amendments to expand the definition of accredited investor. So I commend you for that. One of the most frequent frustrations, I think, in normal 506 Reg D type offerings was that you could offer it to accredited investors and no more than 30 or whatever the number was, non-accredited investors. But in point of fact, due to potential liability, very few lawyers would allow their client to offer to so many non-accredited investors. And so what I found time and time again, it's the inventor, it's the scientist, it's the person with a PhD, it's a CPA, it's somebody with a CFA, it's somebody who's a registered broker-dealer who want to participate in a Reg D offering. They certainly have the knowledge to do that, but they're excluded due to the net worth test or income test. So is one of the things you're considering expanding the definition for professional qualifications or expertise in a particular area?
It is the expansion of the accredited investor definition, updating it to include folks who may be sophisticated but not meet financial tests is certainly under consideration. It's one of the items that the Small Business Forum observed as well. As I mentioned earlier, we take those comments seriously,
right,
and that's something we will be considering.
Well, we've got a lot of bipartisan support for that, and I appreciate Mr. Schweikert of Arizona being one of the leaders in the House on that topic. My colleague from Indiana was talking about 404, and I really encourage you to, after the decade or so post-Sarbanes-Oxley, that really the Commission think differently about it. I mean, we impose this internal control regime that only maybe a financial institution would have on every public enterprise, regardless of business model and regardless of size, with the small cap exemption that you noted. And really, I would love to see an economic cost-benefit analysis of who's benefited from that. You know, the purpose of it was that Arthur Andersen and Enron were running a black box, and the transparent internal control process was bypassed, and that shareholders couldn't determine what was happening. And yet 404 was fully present during AIG, I'm sure, and some would argue AIG was a black box. So I really think we ought to step back and see what is the real benefit of this, and how can it be customized by industry or by size of business, because I think it has probably far exceeded its benefits and burdened particularly our small cap companies. So I do support expanding the size exempt from 404, and I think another one of our industries that has perpetually come to the Commission for an exemption is the small broker-dealer industry. under 404 for a separate audit, and I wonder your views on if you would be supportive. That's more of a regulatory issue for the commission, but are you supportive of some industries that are heavily regulated, like a small BD, small broker-dealer, overseen by FINRA of the commission, from being exempt from 404 permanently, although it's been waived many times over the last decade?
The application of some of these rules to the broker-dealer community is something that the Division of Trading and Markets would be better suited to address, so I wouldn't want to jump into their space, and I hope they don't jump into mine.
Thank you for that. You also talked in your testimony about materiality, and it seems like there's been real mission creep out in public reporting, in that we're getting beyond a materiality standard. Do you, having practiced law for all these years and helped many, many companies navigate the public process, do you support a materiality standard for our public disclosures and not kind of going beyond that unless a company wants to go beyond that?
If I understand your question correctly, I think you're saying companies just need to disclose what's material, and that's it. We do think that a number of the specific requirements that are qualified by materiality, but which remind registrants to describe parts of their business, to do certain disclosures with respect to their results of operations, the MD&A, all again qualified materiality, it's helpful. We think the issuers find that helpful to have the guidance that gives them the sense of what are we as the securities law experts saying might be material. But we do, in general, think that a materiality standard should be applied to disclosures generally, and we have a rule that says even if we haven't hit something in our overall requirements, please tell us what's material. In practice, I was focused on that.
Thank you. Yield back.
Gentleman's time has expired. Seeing no further questions, I'd like to thank our witness today for your time and your expertise and your attention to this. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair, which will be forwarded to the witness for a response, and ask our witness to please respond as promptly as able. I know I will be sending in a question regarding Reg A+, to put you on notice on that one. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. And again, thank you for your time, Mr. Hinman. We appreciate it, and the hearing is adjourned.
Thank you.